Hi everyone, this is your daily 10-minute business and finance news wrap for this Friday, the 23rd of April 2021. Later, how the COVID winners are becoming losers, but first to AMP, which has set out a proposal to demerge. It's a major restructure after a tumultuous few years at the 171-year-old financial services giant, found to have charged members fees for no service and amid allegations of sexual harassment within the organisation. So now, after talks with a potential US buyer ended, AMP is splitting into two. AMP Limited, which will look after smaller domestic investors with things like wealth management and banking led by Alexis George, and its Capital Private Markets unit, which will be demerged and eventually listed on the ASX, focusing on larger global investors. An international search is underway for its CEO, and the demerger is expected to be completed by the first half of next year. And one of its major shareholders, fund management company Allan Gray, which holds around 6% of the company, has welcomed the move. And I spoke earlier with Tim Hillier, an analyst at Allan Gray. Tim, do you support the AMP demerger and why?
I think it's a good outcome for all parties, not only for shareholders who get to retain ownership of what has been a very good business, but it's also for clients and employees. I think it allows an entrepreneurial management team to take charge, which is probably important, and concentrate on delivering value for the clients of AMP Capital. It's also fantastic for employees. They can be part of a smaller team who's focused on growing the business. And then I think it also increases alignment for all parties in a much simpler structure. If there's one thing we probably aren't a fan of, that is AMP Limited retaining a stake in the business. We think that adds unnecessary complexity, but I'm sure that's something we can resolve in time. So overall, we're very, very supportive of the demerger.
Do you think this is the best possible outcome, given the discussions with this potential US private equity buyer fell through?
I think so. I think it certainly simplifies the structure. It isn't a major surprise that the transaction fell over. It certainly seemed to be heading in that direction for a while. Compelling cash offer is always something that's nice to have on the table. But in the absence of that offer, we think a demerger is certainly more attractive than a part sale of the business. And the structure allows us as shareholders to retain ownership of a business that has performed very well in the past, and hopefully in the right hands will continue to perform well in the future.
And what should happen now, given that we've got the AMP AGM coming up this time next week, because there also seems to be a bit of talk around the remuneration report?
Look, well, what should happen now? I think that is the overwhelming focus for us, is what AMP should be doing now. And I think, putting the AGM to the side for a second, I think they're doing a lot of the things that they need to be doing at the moment. They're simplifying their business, they're reducing complexity, removing conflicts of interest. So these are all things that we think they need to do, and they need to do that so that they can put a compelling set of products in front of their customers. And if we think if they're able to put a compelling set of products in front of their customers, then we as shareholders will do fine. So that's the major focus for us. We think they're going in that direction. If anything, we'd like to see them do that a little bit faster. So that's probably our main message to them going into the AGM. And we've been talking to the board ahead of the AGM. We have some concerns around the remuneration structure, which is not at all unusual. It's rare to come across remuneration structures that we view favorably. But we just want to see them get on with running the business and providing their clients with good products and services.
Tim Hillier there from analyst Allan Gray. It's a major shareholder of AMP, and AMP shares rose today by 0.9%. To the broader Australian share market now, the S&P ASX 200, which rose only 0.08% today to 7,060. So for the week, the market was pretty much flat. The banks did well today. ANZ, the best, up 0.4%. Resource stocks were mixed. The best performer was that tech stock Nuix, up 7.4%, but it followed a really bad day yesterday. The worst was online retailer Kogan, down 14.3% as March quarter revenue fell. For a look at the day on the markets and for his investment outlook, I spoke earlier with Paul Xiradis, the Chief Investment Officer at Ausbil. One of the themes we're starting to see is this reversal of the pandemic boom. So today, Kogan shares tumbled after a 24% fall in March EBITDA. Yesterday, online shopping group Redbubble reported a surprise loss in the same period. And then we heard about Netflix saying subscriber growth is starting to slow. So wasn't the issue for the pandemic beneficiaries about how they're going to maintain growth going forward?
Yeah, I mean, that's one of the things that we called out early as well. We have been of the view that that some of the winners of COVID are likely not to be necessarily the winners as the economies reopen. And really that's what is happening. People's behaviours are changing, not only just being stuck from home and doing things, but actually all being out and about. And that's what is really influencing the impact of those earnings growth or sales, that people are just getting out and about and doing things directly, but are still using electronic forms such as COVID to do their shopping. But the extent of it is actually shifting.
So are we still seeing this shift from growth to value then? And are there still some growth stocks that are potentially going to benefit this year?
The answer is yes, but clearly what's happening as well is that we are in an economic backdrop which is quite positive, which means we are seeing a cyclical recovery in activity, which normally are value type stocks because they're more attuned to the strength or otherwise of the domestic economy. So the leadership is changing somewhat. And because of earnings starting to expand in a far more meaningful way, rather than being contracted only to those certain sectors, we are seeing a shift away from those expensive high growth sectors to more the value recovery sectors. And that's what we are seeing in the marketplace. And I do believe that will continue for a period of time.
The story of the day is AMP, I guess, pursuing a demerger of its capital division private markets after ending its talks with Suitor Heirs Management. What do you make of it?
Well, it's another restructure, isn't it? And I must admit that AMP have announced a number of restructures over time. Look, I think they had to do something in order to try to rechange or refocus the business. And I think by doing this, it allows them to do so. It's certainly been an area where AMP Capital have been under attack, and by spinning it off, it allows them to trade independently and perhaps let the market decide on the overall value of that business. It is a business in the past which has been growing quite strongly and has also been the key driver of profit growth for AMP over the years. So by spinning it out, I think it addresses a couple of issues. The rest of AMP is still a little bit under question in the sense of bit of a question mark of what the value of the rest of the business will be. But I think it just allows them clean air to actually focus on their existing business, at the same time spin off a value-orientated business as well.
Okay, let's talk about the larger financials now. With the economy recovering faster than expected, housing market booming in many parts of the country, what's the outlook for the banks?
We've been quite positive about the banks, and we still remain so. We think that again, will be driving the banks is overall volume growth, which is increasing, as in housing, demand for housing, and obviously housing loans. We're also seeing some business loan growth as well, so they're two good positive drivers. But the key driver to the bank's profitability just in the medium term is the adjustment which is occurring about bad and doubtful debt expectations. They were adjusted up quite dramatically 12 months ago. They are being reversed now. And we also, the outlook is such where we think they're going to be lower in line with a stronger economy. So if you translate all those factors into what it means for earnings, it's going to be a lot stronger than what the market's anticipating. We are expecting some further upgrades for the banks, and we're also expecting pretty strong dividend growth for the banks over the coming 2 years.
Speaking of dividend growth, are you expecting that as well in the resources sector, given we've seen the iron ore price surge to 10-year highs, and how is that being reflected in the sector?
Yeah, look, I mean, the resources sector will mainly BHP, Rio, Fortescue, which are really orientated towards iron ore. Back in February, probably had their strongest period as far as dividend growth is concerned. The iron ore price has held up and has actually gone on with it. So it is likely that the coming period will see a very strong earnings growth again for those companies, which will translate into stronger dividend growth, which is a little bit unusual. I mean, you don't normally expect resource companies to be driving dividend growth, but in this case, that is certainly the case because the iron ore price is very high.
That is Paul Xiradis there, the Chief Investment Officer at Ausbil. That is SBS On The Money for this Friday to end out the week. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.